Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. It's Friday, it's the 7th of July, and my email address is rshaw@fxcm.com. If you'd like to email me, that's the email address that you can use, and I'll respond as soon as I can. Just going to go ahead and bring up our disclaimers. We'll start off with the high risk investment warning. And we do have a live trade today. We've got a trade around the non-farm payroll. If you'd like to join for that, I am pasting the link in the chat. Just go ahead and click on that link and register, and you're more than welcome to attend. I'm going to go ahead and bring up our market commentaries disclaimer. Okay, and just the references MarketScope 2.0 and TradingView.com. Right, I think best to start with TradingView because I think we need to keep on top of interest rates. What I've got here is the real rate, the real 10-year rate, which is effectively the US 10-year minus the break even. That gives us the real rate. And if I go through to the daily chart here, just take a look what happened yesterday. Let me get an arrow here. And you can see that we had a really big move up yesterday. And the reason for that is the ADP jobs data came out and it really crushed forecast. Forecast was at 226. It came in at 497. So basically almost double forecast. It's going to be very interesting to see what happens with non-farm payrolls today, but the market immediately adjusting the rates, and not only is there a thinking that the Fed has to stay higher for longer, there is now a pricing in of higher rates than current, so more rate hikes for longer, and that's what we're seeing in the real rate as it's moving up here. Okay, now that's very interesting from our perspective, because what we've been looking at is the stock markets. Specifically, we've been looking at overbought stock market. So this is the NASDAQ 100, and we've got this overbought condition. And the fact of the matter is, it's unlikely that we can stay overbought for very long. Because it's a weekly chart, it makes it a little bit more difficult in terms of timing, because timing on a weekly chart can be this week, next week, the week after, 3 weeks time. So the idea is it's not particularly narrow enough for timing purposes, but it certainly is a warning when the RSI is above 80. And that the whole reason that we include the RSI in our models is specifically to skew the risk when it is overbought or oversold. And that's what we've got here. So let's just understand, we've got an environment now where rates are moving up. Okay, so interest rates are moving up, and we've got this overbought condition with speculation from our side that that overbought condition needs to normalize, it needs to resolve itself. That seems to actually fit together, and it's something that we're going to have to watch again very closely. And the reason that I say that it fits together is really the time value of money calculation. And let's just take a look at that. And what we have here is we've got something called present value. Okay, present value equals future value. Let me just fix this up. Okay, then we would have the future value over, let me try and get this as straight as, there we go. Okay, and the denominator would be 1 plus I'm going to call it interest. Yeah, it's not really interest, it's rate of return, and then to the power of time. Okay, so that's our formula. And what we can see here is that the interest rate component is on the denominator. The present value, what prices are right now, present value, is on the numerator side. So there is a inverse relationship. So what we can do is we can put present value over 1. Okay, just to highlight that it's a numerator and interest is a denominator. And that makes a world of difference, because when interest rate increases, when interest rates are increasing, and the question I pose to you, are interest rates increasing? And the answer to that is yes, they are. We're looking at yesterday's movement up. Okay, so as interest rates increase, what happens to the present value? Well, because they are on different sides, okay, one's the numerator, one's the denominator, present value is going to be pressure to the downside. So as interest rates move up, present values move down. Okay, and that's what effectively what we're seeing, I think, take place in the markets now. So if we go through to the NASDAQ daily chart, you can see that it slipped from zone 1 into zone 2. Zone 1 is our bullish area, zone 2 is our neutral, zone 3 is our bearish. But the slip from zone 1 into zone 2 is relative weakness. Okay, and what we put over here is a lower peak, and I think we can take the question mark out. So it does look as if there is some weakness that is starting to seep in on the NASDAQ. Peak, trough, lower peak, and now the question I pose to you, are we going to get the lower trough? If we are going to get the lower trough, because again, we don't know with any certainty the direction of movement, right? But we can make inferences, and if the interest rate is moving up, it would make sense that the present value of NASDAQ moves down. NASDAQ in particular, because NASDAQ is what we call a growth index. Growth stocks, growth indices are very sensitive to interest rate movements, more so than value indexes and index stocks. I think what we got to watch here is the RSI, and if that RSI dips below 50, I think we can probably expect a movement from zone 2 into zone 3. Now, something is happening here which I want to point out, something that we're going to have to be very, I think, aware of, and that's the Bollinger's are starting to squeeze. Now, we don't quite have them tight yet, but they are starting to squeeze. Why I think that's important is because Bollinger theory presupposes that there's a cycle to volatility. In other words, when there's a squeeze in volatility, it's the precursor to an expansion in volatility. And when there's an expansion in volatility, it's a precursor to a squeeze. Well, if we're getting a squeeze, it's suggesting that we are having sort of the calm before the proverbial storm. And if the weekly overbought condition is going to clear, then we could have a sharp movement to the downside. A sharp movement to the downside. Now, we're going to get all sorts of media commentary if that is the case, because again, I want to reiterate, we don't know with any certainty if that is the case. But the way that we would monitor this, is with peak and trough analysis. Peak and trough analysis is the building blocks for trend analysis. So what we would do here, okay, is we would look to see if there is a pullback, and it could be a vicious pullback. It could be, but as long as it charts the higher trough, it becomes a potential exploitable opportunity, right? As long as this trough is higher than the last higher trough, which is higher than the last higher trough, okay, which would be higher than the reference trough, okay, then this becomes a very interesting setup, because potentially what we could do is we look to exploit the dip in the uptrend. Again, we're making huge suppositions here, but we are making the suppositions as interest rates increase. Okay, we're applying time value of money logic to what happens when interest rates increase. Now, ADP yesterday really did crush it to the upside. Non-farm payroll is way more important. Okay, so the data that comes out this afternoon is going to be way more important. If we crush it on the non-farm payrolls, then I think we have a very good probability of this scenario unfolding. Okay, let me just see. There is a question here from Gurdeep. Let me just take a look at it. The big caps are throwing off cash in NASDAQ, less impact of interest rates, more to impact of the customer on interest rates. Gurdeep, are you able to rephrase that question? Just sort of make it a little bit clearer in my mind. I'll answer to what I think you're asking, but just if you can sort of clarify it for me. What we're looking at here is not so much as the interest rates that's going through the income statement. That's not what we're really looking at when we look at the time value of money. What we're looking at is effectively opportunity cost. Okay, so what we're doing is, well, if interest rates are moving up, okay, if interest rates are moving up, and I am a risk-averse investor, where am I going to put my money? Am I going to put my money into a growth stock which doesn't pay dividends, or am I going to put my money into sort of the money market, bond market, fixed income market, where I am almost guaranteed, and in some cases I would suggest guaranteed, of getting a coupon payment? And that's what we're looking at. We're looking at the opportunity cost of going into, so it's opportunity cost. So that's what we're looking at here. So when the interest rate is moving up on the time value of money, in this case, we're looking at it in terms of opportunity cost. Yeah, very good question. All right. So that's very interesting in terms of what's happening with NASDAQ. And then NASDAQ, I think, could lead the other markets. It would be the more sensitive to interest rates than your value stocks. Why would it be more interest rate sensitive, Gurdeep, than the value? Because the value stocks tend to pay dividends. The growth stocks tend to retain money to reinvest into the business, so they don't pay the dividends. Okay, something else that I think is worth just talking about as interest rates start moving up. The volatility on the Forex market is very low. We'll go back to the US dollar. It's very low. We've looked at this, and what I want to do is I want to take a look at the US dollar on trading view, and I want to show you guys something here. So let's just go through to trading view, and what I'm going to do here is I'm just going to bring up the FXCM US dollar basket, and I'm going to go through to our weekly, and what I'm going to show you again is, of course, the fact that we are moving in a symmetrical triangle. Okay, we know all of this. We are going to add to the analysis now. Now, remember what I told you in terms of Bollinger Bands. Bollinger Bands, the theory is volatility tends to cycle. So let's just add in a Bollinger Band here. Okay, and let's just take out the symmetrical triangle. And look what's happening with the Bollinger Band here. You can see that there is a squeeze here. It's gone it's squeezing. Let me just fix this up. I beg your pardon. I don't want to extend right. Let's put in the border and take out the background. Okay, blue on blue is not great, so let's just change this to green. Okay, there we go. So the green rectangle showing the squeeze in the Bollinger Bands. I want to add in another indicator. It's called the Bollinger Width Indicator. What the Bollinger Width Indicator is, it actually measures the distance between the upper and the lower band. So just go into your indicator, click on that, and just put in Bollinger Width. And in my opinion, it's a better indicator to see just how tight the squeeze is. So what you want to do is you want to go to Bollinger Bands Width, Bollinger Band Width, and take a look how tight we are. Okay, if we just put in a horizontal right over here, you can see how tight we are. This is actually quite strange. Between 2019 and 2020, this is very interesting, very tight squeeze here. It does lead, ultimately, it does lead into the expansion, the breakout there. These squeezes down here lead to movements up like that. And I think we've got to just be aware that if there is interest rate movement and according to the time value of money, it may impact on the volatility of an instrument and such as the dollar and the Forex market, potentially exactly because of that opportunity cost that we spoke about. We're very tight here. Okay. This over here is very tight. We're going to have to keep watching. I would be very surprised if it maintains this low volatility here. That would be extremely surprising to me. But if we had sort of these sort of sharp dips and then the movement up after that, that would be interesting because it would mean that the volatility is starting to increase. And that's important for us as traders because volatility is what we need to trade. What we're going to do is we're going to keep an eye on the US dollar. I've added a 30-week moving average here. I want to see how the candlestick reacts, or the interplay between the candlestick and the 30-week moving average. If that moving average moves up, I want it to drag the 30-week up. If it moves down, I want it to drag the 30-week down. That would, to me, suggest that expansion in volatility. So the fact that the interest rates are moving here, I think, are interesting. I think it's timely, specifically because we've seen that overbought condition. And this is the fundamental factor that we need to normalize that overbought condition. But the question is, and the expectation is, that will it actually extend into the currency markets as well, which are very flat at the moment. All right, that's where we are going to leave it or conclude for this morning. Please join me for the live trade, for the non-farm payroll live trade. It's going to be very, very interesting. Last week's non-farm payroll trade was very difficult. I'm hoping that we have an easier one this afternoon. Please join me for that. All right, no questions coming in. So let's wrap up here, guys. Have a good morning. We shall speak this afternoon. If you don't join me, have a good day, good weekend, and I'll speak to you on Monday. Thanks very much, guys. Damir, I can certainly send the link to you. Let me send it through. I have put it in the chat, but I'm just going to send it again. Did you get it, Damir? Just let me know if you've got it. Otherwise, if you can send me an email, I shall respond to you. Did you get this? It's not a link. That's weird. Should be. Let me try again. Damir, if I may request you to send me an email, I shall ensure that I send you the correct link. I'll just write my email address down for you. Okay, anybody that needs it, just send an email to. All right, guys, let's wrap up here. And Derek, just send me the live trade will be recorded. Yeah, David, definitely will be recorded. It will go into our YouTube channel. Yeah. All right, Derek, can you email me? I shall respond to your email with the link as well. Anybody that needs it, just shoot me an email. Happy to send the link through to you guys. All right, guys. Thanks very much. Chat to you a bit later in the day.